levels still remain weak. Monthly inflation has been around the midpoint of the inflation target range, as food and services inflation remained subdued. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 4.3% in August. Goods price inflation in August was 3.9%, while services price inflation remained at 4.7%. Food price inflation rose to 3.9% due to rising cereal and bread prices. The bank's measure of core inflation, which excludes food, fuel, and electricity, rose slightly to 4.3%. Producer price inflation for final manufactured goods decreased to 4.9% in July. The medium-term inflation outlook is largely unchanged. The inflation forecast generated by the SABC quarterly projection model is for headline inflation to average 4.2% in 2019. The projection for 2020 is unchanged at 5.1%, and for 2021 slightly up to 4.7%. Headline CPI inflation is expected to peak at 5.3% in the first quarter of 2020 and settle at 4.5% in the last quarter of 2021. The forecast for core inflation is lower at 4.3% in 2019, is unchanged at 4.7% in 2020, and is slightly higher at 4.6% in 2021. Electricity, food and fuel price inflation continue to shape the near and medium-term trajectory of headline inflation. Fuel price inflation is expected to average 2.4% in 2019 and to peak at 11.8% in the first quarter of 2020. While food price inflation has generally surprised on the downside, it is expected to peak at about 6% in the third quarter of 2020. Electricity prices came out higher than expected in August at 11.8%, but remain in line with the forecast. Inflation expectations have continued to moderate gradually. According to the Bureau for Economic Research third quarter survey, expectations for headline inflation are down slightly for 2019 to 4.6%. Expectations for 2020 remain unchanged at 5%, and eased from 5.2% to 5.1% for 2021, reaching the lowest levels since 2007. 5-year ahead inflation expectations also declined to 5%. The inflation expectations for market analysts in the September 2019 Reuters Econometer survey have been revised lower to 4.3% for 2019 and remain unchanged at 4.9% and 4.8% in 2020 and 2021 respectively. Market-based expectations implicit in the break-even inflation rate, that is the yield differential between conventional and inflation-linked bonds, have remained stable since the previous MPC. 5-year break-even rates are currently about 4.6% and 10-year break-even rates at 5.4%. Global GDP is expected to slow to 3.2% in 2019 and rise to around 3.5% in 2020. While global growth remains resilient, recent indicators on trade and manufacturing have deteriorated and a range of downside risks to growth remain. Growth in world trade volumes has continued to decline, with trade tensions weighing on market confidence and lowering investment. Other downside risks include geopolitical developments, further oil price shocks, and high levels of corporate and sovereign debt. Across most countries, there is limited policy space to respond to shocks. Inflation outcomes and inflation expectations in most advanced economies remain below targeted levels. Barring significant shocks, monetary policy in major advanced economies will remain accommodative over the medium term. However, market expectations of further accommodation appear high, creating ongoing risk of market volatility should this not materialize. Since the July MPC, the rand has depreciated by 4.6% against the US dollar and by 3% against the euro. The implied starting point for the rand is 14 rands 88 cents against the US dollar, compared with 14 rands 40 cents at the time of the previous meeting. At these levels, the QPM assesses the rand to remain slightly undervalued. While the rand has benefited from improvements in global sentiment, investors remain concerned about domestic growth prospects and fiscal risks. GDP rebounded to 3.1% in the second quarter, following a decline of 3.1% in the first quarter. The sharp quarterly rebound was caused by stronger output in nearly all sectors, including investment and government consumption spending. However, longer-term weakness in most sectors remains a serious concern. Based on recent short-term economic indicators for mining and manufacturing sectors, the third quarter GDP outcome is expected to be muted. Business confidence has declined further. The ABSA Purchasing Managers Index came out at 45.7 points in August, and the RMB BER Business Confidence Index fell to 21 points. The SABC Composite Leading Business Cycle Indicator also continued to trend lower, although the coincident indicator remains positive. The forecast of GDP growth for 2019 remains unchanged at 0.6%. The forecasts for 2020 and 2021 have decreased to 1.5% and 1.8% respectively due to revisions to global growth and domestic potential growth. The MPC assesses the risk to the growth forecast to be balanced in the near term, but remains concerned about medium-term growth and weak employment prospects. Escalation in global trade tensions, further domestic supply constraints, and/or sustained higher oil prices could generate headwinds to growth. Public sector financing remain high. Public sector financing needs remain high, exerting pressure on the currency and pushing local bond yields higher relative to country peers. Implementation of prudent macroeconomic policies and structural reforms that lower costs and raise investment and potential growth remains urgent. The overall risks to the inflation outlook are assessed to be largely balanced. Demand-side pressures remain subdued, and food, wages, and rental prices are expected to increase at moderate rates. Global inflation should remain low. In the absence of shocks, relative exchange rate stability is expected to continue. Some upside risks to the inflation outlook remain, in particular from fuel, electricity, and water prices. The MPC welcomes the sustained moderation in inflation outcomes and the fall in inflation expectations of about 1% since 2016. The committee would like to see inflation expectations also anchored closer to the midpoint of the inflation target range on a sustained basis. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.5% per annum. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interest of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the assessment of the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates over the forecast period generated by the quarterly projection model indicated no changes to the repo rate. This remains a broad policy guideline which could change in either direction from meeting to meeting in response to new developments and changing data and risks. That concludes the statement, and as usual, I would open the floor for questions, and please identify yourself and the name of the media house that you represent, and we will deal with your questions. Amukela.
Good afternoon, Governor. I'm Khelang Bata from Bloomberg News. Governor, in the context of the attacks that we saw in the Saudi oil refinery over the weekend, does the bank's forecasts for oil prices factor the risks emanating from that particular attack, particularly when you think of the supply disruptions that we could see and oil price shocks, particularly in the context that we see that you have cut your oil price forecasts for the next 2 years? So do those factor in any shocks or disruptions that may impact the oil price?
Yes, ma'am.
Governor, it's Pranesha from Bloomberg. In their previews, many economists predicted that the SARB would keep the rate unchanged due to concerns about fiscal risks and also the threat of a Moody's downgrade. Did those factor into your discussions at all, and to what extent? Thank you.
Is that it? No other? Okay. Amakela, the forecast that we table was done last week. That was before the attack, so it doesn't factor those things in. But be that as it may, when you have the attack, the question is always going to be how quickly can production be restored, and that will have an effect on the price going forward. But our approach when these kinds of events happen is to assess, is this a once-off shock, and could we see through that? And that's exactly what we do. We look at the thing, and if we find that it was a once-off shock, we look through it and see whether it changes the outlook. If it does, then there might be a need to adjust a policy to deal with those kinds of shocks, whether they are positive or negative. Pinesha, fiscal risks and possible Moody's downgrade, those are always at the back of our mind. They are unknowns. So it's difficult to factor them into anything that we do because we do not know what they would be. Moody's will be doing its visit or making its decision sometime in November, and when that comes, we will deal with it then. It's a question of, if it is a downgrade, is that downgrade in current prices or not? If it is in current prices, it should not have an effect. But if it is not in current prices, you should expect that there would be outflows of capital, and that will manifest itself in the exchange rate. And the way we think about it is that it's a shock. We do not respond to shocks in that manner. We would then look as to whether second round effects kick in. If second round effects kick in, then we would respond to those second round effects rather than to the first round shock. Any other questions? Anybody there on the line?
Yes, Governor. Razia from Standard Charters. With the MPC remaining data dependent, what might raise the risk of renewed easing? Would it be correct to rule out any easing unless inflation expectations move towards 4.5?
Is that it?
That's
Thank you
it
very
from-
much. Any other questions from the House? Okay. Razia, let's turn this thing this way and say that the focus of policy is on what we are tasked with, which is to keep inflation within the target. And in our case, we say that we would like to see it closer to the midpoint and inflation expectations anchored to the midpoint. We are data dependent. Yesterday's inflation means nothing for future policy, because that is yesterday's inflation. The focus that we have is what is the outlook for inflation going forward, and that is what we respond to. So the data that comes through should be telling us what we think would happen to future inflation, and if there are changes to the future inflation based on that data, policy will be adjusted accordingly. Lucanio.
Hi, Governor. Governor, considering that your counterparts elsewhere have been loosening policy, aren't you concerned that this may put upward pressure on the currency, possibly damaging the second half of your mandate, which is to support growth? And I note that you've actually downgraded your longer-term growth focus for 2020 and 2021.
I don't know whether I should say that our colleagues in other parts of the country followed us in August. If you ask them, they will tell us you they didn't. And neither do we follow them when they do things. We are a small open economy. Developments in the advanced economies do affect us. They affect us through two channels. Firstly, the trade channel, and secondly, through the financial channel. And at the moment, we get affected mainly through the financial channel. And what is important for us is that when those changes take place elsewhere, we have got to then ask ourselves, what would be the impact on the South African economy? So our response would be what the impact is on the South African economy of any of the developments from the other countries, mainly the developed economies. The outlook for the currency is a complex matter. And it used to be that in the past, the currency could just be driven by what central banks do with policy rates. But in today's more integrated economy, there are so many moving parts that would affect a currency. And in our case, the currency has tended to actually be more responsive to the movements in capital flows, and those capital flows could be equity, or they could be bonds, or both. And the important thing here is that the behavior of those two categories of portfolio flows vary. Equities tend to respond to the changes in the growth outlook, whereas bonds would respond to changes in the inflation outlook, because the changes in the inflation outlook tells them what is likely to happen with future movement of interest rates. So, cut a long story short is that we do not see pressure on the exchange rate just because our colleagues elsewhere had moved and had cut rates. They face different circumstances. The US had cut rates because they are trying very hard to generate inflation. That is not the problem we have in South Africa. So we keep on comparing ourselves to countries which have got a low inflation problem. Our problem is not that we have got low inflation, and so we get assessed differently. Well, in the absence of any further questions, Sianda, you also want to ask a question?
Governor, 3. Peter Montalto from Interlip. Governor, can you please talk a little to the likelihood of structural reforms, particularly in light of the Tito paper, and if reforms don't come, does the central bank have to take a different view on rates higher or lower?
Yeah.
Michael Potgieter from ETM Analytics. 2 questions for the governor. Has the bank assessed to what degree is the government's high financing requirements crowding out credit extension to the private sector? And is the bank concerned that we see offshore investors offloading SA government bonds further? If so, what scenario planning is taking place around this? Andrew Matteni from BER. Governor, it seems to be very dovish statement, yet unanimous, for no change in the repo rate. This seems to be large shift from unanimous of a 25 basis point cut in July. Can the governor help to explain this? Last one, Governor.
You said 3.
This is the last one. To what degree do you assess that a downgrade from Moody's is priced into the market?
I've dealt with that one, so there is no need. Thank you very much. The likelihood of structural reforms, it is good that such a discussion is taking place, but it's the other guys down the road who must deal with structural reform. We have been raising these things for a long time, that we need the structural reform to lift the potential growth rate of the economy, and we are glad that finally government is talking about those structural reforms. Relationship between structural reforms and rates, it is not that apparent what the relationship would be, because monetary policy reacts to cyclical factors rather than the long-term structural issues. And Michael had a question about government's financing requirement and whether it is crowding out private investment. Too early to tell. We do not have that information or any evidence that there is a crowding out. And the crowding out most of the time also works in a closed economy. We have got an open capital account where you have got participation by foreign players in our bond market to the extent of around 36% of government's debt being held by foreigners. So there is access to capital flows from elsewhere. So we can access foreign savings through that mechanism. So. Yeah, let me leave it there. And then the thing about offshore investors coming out, I think that it is in the same manner that I dealt with the question earlier. It's a function of whether we are downgraded or not. It's a function of whether the downgrade has been priced in or not. And at the moment, none of us can give you definitively whether the thing is priced in or not. Okay. Ma'am.
My learners want to ask questions.
Yes, I just wanted to make sure that the adults are done. Lucanio.
So, hi, Governor. So I was just slightly intrigued with how the QPM works, because last time it was implying a cut before the end of the year. But based on your statement, things are broadly much balanced, if unchanged. But the QPM has changed. I'm just wondering what has caused that to change, because it doesn't seem like it's your inflation forecast has changed or anything else has changed.
Okay. Now it's an easy one. The QPM said that we must cut rates in the 4th quarter of this year. We decided to do it in July. So once you have done it, the QPM will say, okay, it's done. So because it's done, there is no need, and that is why it remains flat. Okay. So that was the thing. Thank you very much. And my dear learners, you have got a question. Oh, the adults are competing with you.
Sorry, Governor, it's just a follow-up on Lucanio's question. Does that mean that a rate cut is ruled out for the rest of the year?
Like we said, the QPM is a guide. When you come to the next meeting in November, and we have considered all the data, and we have forecast our inflation and GDP figures, you will know for sure what we are doing for the rest of the year. Okay, thank you very much. My learners, you want to ask me privately, you don't want to ask here? I'm sure you can ask.
I would like to know, what was the impact of the escalating trade tensions between the US and China on the decision? And if the trade tensions continue to escalate, what will be the impact on your next decision?
Good question. I can see the adults being jealous. They wish they asked that question. Yes, ma'am.
Considering the weak employment prospects, as you have mentioned, and unemployment currently sitting at 29%, and I know that your mandate is to solely curb inflation, but we can't ignore this factor. How do you think the now repo rate that you have released, how do you think it's going to curb the high unemployment that we are currently facing in South Africa?
Okay, thank you.
Oh, Governor, sorry, to add on what my learners are asking, I'm Ms. Rapanyani from Midrand High. So I need to ask, with the recent unrest and xenophobia allegations, are we not supposed to be worried with the effect it will have in the economy?
Thank you very much. Trade tensions. In a trade war, there can't be winners. We can only all be losers. And in this case, the loser is the global economy. South Africa is part of that global economy. We are small, and what we have seen is that these global trade tensions actually dampen global demand, and they actually lead to slower world growth. And one of the factors that we actually put in as to our revision of growth going forward has to do with the fact that we expect that global growth will be slowing down. So that is how that channel works. We produce stuff here that we sell in the global market, and if the global economy slows down, it means that the appetite for us to sell our goods into that global market is actually adversely affected. Employment, you know that employment is an outcome of growth. So if you want employment, you're going to have to generate growth. Absent growth, you cannot have rising employment. And so you said that our mandate is to solely look at inflation. No, actually, the Constitution says we do this thing in the interest of balanced and sustainable growth. So we constantly have to watch what is happening with employment trends, because they matter on what is going to be happening to inflation also going forward. So our stance, monetary policy, affects cyclical growth. It doesn't change the long-term trend. And if you had the question that was asked about what are called structural reforms, that is what you need to change to lift the potential growth rate of the economy. And if you make the necessary changes and growth goes up, that is where employment is going to come from. What monetary policy does is that it affects growth around that long-term growth potential of the economy. The attacks, we didn't discuss these attacks, and it's difficult to assess what they actually mean. All that we could say is that anything that disrupts economic activity in such a weak environment will not be good for the business environment. And but to what extent would it have affected economic activity? It is something that we cannot have our finger on. Yeah, let me leave it there. Thank you very much. That concludes the business of today. I will see you same place in November.
Well, that's officially it then. The second last Monetary Policy Committee meeting of the year has yielded a no decision, in the sense of no cut in interest rates, neither a hike as well, leaving it as it is, 6.5% for the repo rate. The prime rate still remains at 10%, according to the governor there, Lesetja Kganyago. We'll get to unpack a whole lot of exactly what has been said there by the Reserve Bank governor, and the permutations, of course, whether they be international, whether they be local, and the things that they took into account as well. And our guest, John Lewis, will help us unpack that a whole lot more right after the short break. Do stay tuned.
We stay on the visuals, they're busy shooting.
We drove around this.
Many often share their worry about artificial intelligence taking their jobs away. The truth of the matter is that artificial intelligence does a lot of things faster and better than humans.
That machine didn't make itself, it was made by a human being. So which means us as human beings, we need to think more on the skills which we have.
I feel like ultimately it'll increase productivity and efficiency of things.
There was a lot of apprehension from the staff. The staff is really worried, what's going to happen, am I going to lose my job? Is machines going to take over the world? The reality of the matter is, though, that the future is a blend of humans.
I don't like the sound of it too much. The fourth industrial,
On Network every Sunday at 8:30 p.m.
Welcome back. Of course, we've just seen the decision there by the South African Reserve Bank's Monetary Policy Committee to hold interest rates unchanged and keep them at 6.5% for the repo rate, the prime lending rate then at 10%. Let's unpack all the permutations, everything then that was said by the Reserve Bank governor there in that discussion. In studio, I'm joined then by John Lewis, who's F&B property sector strategist. John, thank you so much for the time.
Pleasure.
Unsurprising, really, surely, right? So it's a decision that we all kind of expected here.
Well, I mean, I think there was possibly a debate about a cut, but yes, our expectation was the most likely was unchanged. It turned out that way. He gave in the end, he summed it up by saying the balance of risks is, the risks are balanced to both sides. The inflation rate is near the midpoint where he likes it to be, 4.3%. So not a lot to be done, really.
My worry, though, is that with us having said that the risks are a bit balanced, is it not perhaps a time for them to try and encourage and boost as much as possible? It's not, as he said, it's not as if the risks are overly to the downside, so we're not going to get too much hurt. And it seems that the oil saga is certainly coming to some sort of peaceful end in a way. Should it not have been a time perhaps for them to be a little more bold and decide to, perhaps cut a little?
I'm not convinced. Our Reserve Bank has a history of probably not being bold. If I look at what the US Federal Reserve has done in bygone years to stimulate growth, and I think that stood us in good stead. A central bank, at the end of the day, in my view, is there to look after macroeconomic balances, to keep things sustainable, not to cut rates and boost consumer debt unnecessarily or anything like that. And growth really needs to be driven by structural change to the economy, good government management, good microeconomic management in certain industries, a whole host of factors that we know, we've heard a lot about, which falls totally outside the ambit of the Reserve Bank. Right now, the way Reserve Bank policy is, it is very accommodating by our standards, given where our inflation rates are. I don't think we can say these interest rates are high. And they're very stable. And I think there's a lot to be said for stable monetary policy, not moving too fast, either downwards or upwards for that matter. So I think it creates stability, it promotes stability, and that's a good thing.
Yeah. As I asked you my question there, just about whether they're bold enough or able to move forward, it actually reminded me of the sentiment that Donald Trump actually said towards Jerome Powell, the U.S. Federal Reserve Chair, and he said that he had no vision and no sense because he should have cut interest rates a whole lot sooner. Do you think that cut in interest rates from the United States played a part, and how heavy a part it may have played in this decision by the local bank?
Well, you know, when a central bank, a major central bank such as the US is leading cuts downwards, as they do, it possibly provides scope for, at some point, for us to cut as well, to go in sync with them. So it was probably discussed, but you know, if one looks at, they look at the local risks as well. Yeah. We do have rising government debt. We know that. We've got the risks of downgrades that's widely speculated about. That if downgrades happen, and if there is a significant loss of confidence in investing in our government debt, for instance, you can see pressure on the currency, and that reintroduces imported inflation very quickly. Yeah. So there's those locally or homegrown risks which can create inflation at the sort of drop of a hat. The other day we had the Saudi attacks. Suddenly oil prices were elevated. It's not bad at this point, but it just highlights those geopolitical risks which can drive inflation through things like oil prices. So there's upside risks, and then on the downside there's yes, major central banks relaxing on monetary policy. Put that all together and you've got quite a balanced inflation outlook. I think what they're saying about the balanced inflation risks and outlook is realistic. So then you tend to be boring and do nothing.
Here's where I play devil's advocate. The mandate, or supposedly the need to keep things between 4 and 6%, 3 and 6%, shall I say? My apologies. Is one that was handed to them by government. They went and made that even smaller and decided now to make it 4.5, and we've accepted that. Why? Because surely it's at 4.5%. You've just said the risks are balanced, and I'm just playing devil's advocate here, so it seems like I'm just advocating for a cut in interest rates. But surely at a time when things aren't as great as we'd like them to be, we should be able to pull a particular lever, maybe, you know, even if it does hinder a little bit on our, you know, how people view us as a central bank.
Well, I'm not sure that pulling that lever, I think there's an overemphasis on what that lever pulling is going to mean. Yeah. You know, back in the late 90s when they pulled the interest rate lever sharply, at that point, there was a low level of household debt.
Sure.
What happened? We eventually had too much debt. That's all. That's ultimately that happened. Now we're in a situation where that debt to disposable income ratio has come down somewhat to 70-something%. That's still high by our historic standards. I don't think the Reserve Bank wants to cause unnecessary pain or anything by hiking interest rates. I certainly wouldn't advocate that at the moment. But if it keeps things relatively stable at a level where you're not encouraging massive consumer debt growth, I think at the moment is a good thing, because while it might hamper short-term growth, because sharp growth or significant growth in consumer debt or housing debt can actually boost short-term economic growth, but where does it end? Where does it land us ultimately? It lands the consumer in trouble somewhere down the line. At the moment, we still have a high debt to disposable income ratio. That's a reality for our standards. So I don't think using interest rates to push that up to drive economic growth is the solution. I think the solution is elsewhere with positive structural reforms, which have been much talked about, the electricity sector and others.
Yeah, I mean, the governor himself spoke about those, right? Saying that we've had so much time where we've spoken about the need for reforms. We're glad they're finally having the conversation. Do you think, though, that there's enough in there to perhaps help the saga when it comes to growth? they still expect growth of 0.6% this year. They've downgraded in 2020 to 1.5 and downgraded 2021 to 1.8.
Yeah. No, look, there's not enough at the moment to help growth. Unfortunately, we've got a pretty poor growth outlook by most economists' forecasts, and ours included. But, you know, if you look at where interest rates are at the moment, let's look at one of the big macroeconomic numbers, the current account deficit.
Yeah.
It's been in deficit for many, many years, and it's a very significant deficit. That means that gross domestic expenditure exceeds national income.
Sure.
This is not a conservative monetary stance. It's where it is now, it's a monetary stance which accommodates a country or allows a country to live beyond its means and pile up the foreign obligations to fund that deficit. That's the big picture.
Yeah.
That's not the, do you want to make that worse? Because ultimately then you can start running into serious rand volatility and all the uncertainty that it brings, which is bad for growth somewhere down the line. So, you know, we're a country that for quite some time has been living beyond its means, as reflected in a constant current account deficit. I don't, you know, if we had a big current account surplus as a country, then you could possibly raise the argument and say these interest rates are too tight. But that hasn't been the case for many years.
Yeah. So you reckon interest rates are okay where they are in terms of the global picture as well? It's generally high, though, compared to everyone else. And I mean, we even have countries sitting in negative interest rates, right? So
well, our interest rates are high compared to many others, but you have to look at them in real terms, adjust them for inflation. You have to look at where our structural inflation is, more or less, let's say 4.5% these days. It's not a 1% inflation economy or so like some developed economies might be. So that requires a higher level of interest rates. And I think what what we've also got to just bring in, if we take this back to the consumer, and this is, you know, I've in the past been quite excited on a TV program about an interest rate cut, and then some elderly person phones me in not such a good mood, and they remind me that they are earning interest on deposits.
Yeah.
There's that side as well.
Yeah.
You know, do we just benefit the indebted all the time? There's another side of this economy too. There's another side of the consumer. It's those that save, those that have fixed deposits with interest rates receiving income. Do we just penalize them with interest rates? I think not. I think you've got to strike a balance there too.
A bit difficult though, considering that as you've noted, household debt in South Africa is still very high.
It is very high. And, you know, I think it would be healthier for that debt to disposable income ratio to be below 70%.
Yeah.
You know, there is a certain amount of debt which is acceptable. It's always difficult to know exactly where that is.
Yeah.
All I can go is on our historic standards and say it's high. Yeah. And there's plenty of reports about the pain that the indebted households of South Africa experience. Regularly you read such reports, and you know, at this stage, with a weak economy, with a tough job environment, I don't think we want to encourage that ratio to rise at the moment. To keep it stable would be a better idea, I think, for the time being.
What has happened to house prices in the meantime? I mean, have you seen sort of changes because of the stability, I suppose, in our interest rates of late? I mean, we've only moved once this year, well, twice this year, yes, but effectively it has been pretty stable.
Yeah, our house price index shows price growth moving along at 3.5% odd. The average for the year, I think, is 3.5% year on year. A very stable, low nominal growth rate. Now, you might say, well, isn't it time we stimulate that? Probably not. I think that the housing market and the commercial property markets both, they're expensive by our historic standards.
Sure. Okay.
And those price levels are not in line with our economic fundamentals at the moment, which are very weak. And ultimately, I believe you want a market that is in line with economic fundamentals, whatever that may be at the time. We're not that 5% growth economy that we were prior to 2008. Don't think they're fully adjusted yet. They are busy adjusting. First prize is that house prices adjust, or property values for that matter, commercial as well, that's the side I look at more, that they adjust gradually. And I'm always in favor of something to adjust gradually instead of shock treatment. And at the moment that is the case. They are below general inflation as measured by GDP inflation or CPI inflation, these growth rates in property markets in general. and therefore we're having this gradual real price adjustment down more into line with economic fundamentals, where the economy and the people in the economy will be able to afford to transact more readily. That's probably got to happen. The slower and more gradually that happens, to me, the better. You don't want this big economic shock which may send it into nominal decline. But to hope for positive real house price growth or any property value growth at this stage, where property values are already high and you've got an economy hardly growing, I think that's unrealistic.
Usually people have a term for the area you sort of sit in, whether it's a buyer's market or a seller's market, really. It surely isn't a seller's market either way, though.
No, it's not. It's definitely become more of a buyer's market in property in recent years.
Yeah.
You can see that on our residential surveys by a lengthened average time on the market, for instance. You can see it. There are surpluses in our commercial property surveys too. There's ample stock in most of the big markets. So that's where we are. Yeah.
Okay. If we talk about the overall growth picture, really, just to get towards the end, I suppose there's always been the sense of, for one, they say that electricity prices are higher than expected. There's a limited policy space to react to many other shocks. We don't have a low inflation problem. All of those permutations come to the fore, and you realize that, and even with growth of around 0.6% this year, we're not sitting as a country that looks like the most industrialized in Africa. Are we perhaps too concentrated on other issues and not focusing on the matters at hand right now? And are we perhaps lagging behind on the things we should be fixing?
I think you could say that. I mean, not to go too deeply into political issues, but there are these big political battles that are playing out, and while they are playing out, they can be a distraction to a ruling party, to a government. So yes, politics has, look, that's a function of the economy to a certain extent. Politics tends to heat up when the economy stagnates.
Yes.
That's as a rule of thumb. And I think you can see it in a place like the United States as well, where there's certain industries, people that have been marginalized, relatively speaking, and they've voted in someone like Donald Trump. And politics has become more aggressive and more combative in the United States. Britain voting for Brexit.
Yeah.
It's a world issue. And I think it has a lot to do with, politics influences an economy, but an economy also influences politics, and it's got rougher because we're in a phase of economic stagnation. So, and it becomes a distraction. It becomes a distraction, and we need serious policy reform. What economists would call positive policy reform, which boosts economic growth sustainably. We need that desperately, but there are other battles being fought and issues or events playing themselves out, which I think are a major distraction.
Also have the rand in 1488 is what they currently set at with an implied rate, 1440 compared to the last period. The rand has certainly improved, though, in a sense, because we went from 1440 right through to 1530 odd, right then back to around, now we're sitting at around 1461. With a slight improvement today. So undervalued still for the local currency. So we're supposed to be looking even better.
Yeah, I mean, undervalued, that would be in terms of purchasing power parity. But, the markets do at times price in a certain risk premium as well. And, if you start taking that into account, maybe not undervalued, then it becomes debatable. So, I think the rand is cheap in terms of purchasing power parity. My feeling is if I were to travel overseas to the United States or to Europe right now, it would be rather expensive for me. So from that point of view. But there are very significant risks that we face at the moment. The governor did talk about those, and I mean, government finance, government debt, and rising government debt to GDP ratio are a key one. And how sustainable is this situation? We are getting more and more speculation about IMF bailouts. That's not a nice space to be in. So whether it comes to that or not, very difficult to predict, but certainly the perceived risk of that has been rising, and that can at some point that runs a risk to your long bond yields, to your well, even to other markets, your equity markets and so on, and your capital flows in your currency.
Yeah. Okay. For the remainder of the year, we have one more interest rates decision for this year. Do we get a cut? Do we keep things the same way for the remainder of the year?
Our first-hand forecast is that we will get a cut. That will possibly be the last one in the cycle, but that it's a very mild cutting cycle, because we are at relatively low interest rates at the moment, given where our structural inflation is. But that, yes, we can before the year is out.
So what will it depend on? Will inflation have to head a little lower as well? Will the oil price spike obviously have to have been subsided completely? Will the Fed have had to have kept the notion that they'll continue to cut interest rates? What exactly are the permutations we need to get to that point, hopefully?
I think a lot depends on what comes out in the medium-term budget.
Yeah.
That would be a big one. And to what extent the Minister of Finance can make the markets comfortable with the idea that there is a plan to fund and turn around these parastatals before government debt gets out of hand.
Yeah.
I think that's so that will be the next month's medium-term budget statement will be a very closely watched item.
Yeah.
But yes, I suppose no more Saudi attacks. That would be another one. If this is a once-off and you go back to normal business as usual in the oil markets without any further disruption, we're looking then at an inflation situation which is very much under control.
Yeah.
But these things, you're not going to predict them. You're not going to predict any further attacks.
This is me holding thumbs for a rate cut in November. Need to pay off that bond ASAP. Thank you so much for the time, John. Appreciate it. John Lewis, property sector strategist then at FNB, helping us unpack that market picture and just really what the South African Reserve Bank, it is your breaking news this hour then, as the South African Reserve Bank has decided to keep interest rates unchanged, 6.5% for the repo rate, the prime lending rate still at 10%. South Africa's currency still doing slightly better, 14.63 on the day. Not too much movement. That's versus the US dollar, of course. Nearly 4% better off this month alone still for the South African currency. Just overall with some other news as well then, of course, the permutations around Moody's and whether they decide to downgrade South Africa. As they've said, they probably will not, but, the chances are still there of an outlook change at the very least. Credit Suisse even saying that we could lose as much as 4 to 8 billion US dollars. That's around a maximum of 118 billion rand if we do lose that investment grade status when it just comes to Moody's as well. And the midterm budget policy statement, well, confirmation then that it will be on October 30. The finance minister having that perhaps just a week later than usual on that front. Of course, we'll give you all of the latest information on that, and as it happens, we'll have that right here on SABC News. Thank you so much for joining us for this special live broadcast, of course, of the South African Reserve Bank's Monetary Policy Committee meeting. 6.5% for that repo rate. We'll chat again soon. From me, that's where the buck stops.
We've been all around the country talking to real South Africans about saving money on their car insurance. Let's meet some of them.
My name is Jacques, and I save 403 Rand a month with our insurance. My wife made it happen. I'm a bit of a procrastinator. She nagged me, phone our insurance, get a better quote. I will definitely take her out for a little something special. As a salesman, seeing how our insurance does business and the way they treat their customers, I would very much like to take the example and teach that to my salespeople as well.
If you think it's a hassle getting a quote, put us to the test. SMS SAVE to 34473 or call 08600 60,000 to see if you can switch and save. Do it now.
My name is Yvette, and I save 1,250 rand with outsurance. I was downstairs, and my husband came down, and he told me about outsurance. Then we can pay less than a half. I can't believe it, and I just hugged him and give him a kiss, and I said, that's great. I've got that car 5 months now. Yo, it feels like